Good afternoon, good morning, everybody, depending upon where you've logged on from. Here we are, Thursday, September 21st, 2023. Can you believe it? We are in Q3, heading into Q4 here shortly. And, you know, the burning question I'm sure in everybody's mind is, where does M&A sit right now? How is the market? Is it a buyer's market? Is it a seller's market? Is it somewhere in between? And hopefully my goal here today is to demystify a little bit of that for you, answer some of those questions. We'll start off with a little bit of the data, and then I will give you, along with the data, my interpretation of that data, layering in, you know, what I see and hear every day, sitting in the seat that I sit in as a lower middle market investment banker. So just to start off, a little bit about me, for those that have not seen my face before, do not know me. I'm one of the founding partners of REAG. We've been in this business for over 20 years doing lower middle market, buy side and sell side representation for business owners, private equity, strategic acquirers. As John mentioned, I sit on the faculty at EPI. I've been teaching the M&A process section since COVID hit in 2020. This year, I'm also the chair of M&A Source, which is a lower middle market association, industry association. I've been on the board of governors there since 2017, and some other stuff that I've done in the past is listed on your screen as well. I'm not going to go through all of that, but the bottom line is I've been doing this for a little while, been through a lot of cycles. I've been through 08, 09, obviously been through COVID. So, you know, here we are in 23, trying to understand a little bit about the data that's out there, what's happening, and hopefully give you some color to some of those metrics. So I guess the things that you're probably seeing in the news, the headlines, are all about economic headwinds. You know, we hear a lot about global uncertainty right now. You know, rising interest rates are clearly at the forefront. You know, as central banks try to tackle, you know, the rising inflation rates that have been going, the rising inflation has been going on for, you know, several quarters now. And then, you know, the result of that is the numbers show what's being referred to as a drastic decrease in M&A activity and M&A transactions. We'll dig into the data. I think at a certain segment of the market, those comments are very fair. At another segment, not so much. And so if we dive a little bit deeper here, and we zoom out and we look at the market and say, you know, why are those headlines the headlines? I think at the bulge bracket level, at the large international conglomerate deals, absolutely, there has been a decrease in the number of deals happening there. So just by sheer numbers, you know, when you run those averages and you run that math, you're going to see a decrease in the overall M&A market, the overall activity. And so some of these larger deals are a large part of what's driving the headlines. You know, the information's public at this level primarily. So it's data that folks can easily get their hands on and report and speak to what is very clearly happening. You know, the other side of that coin, though, is the lower middle market or the middle market deals. And so for purposes of our discussion today, I'm going to talk specifically about deals with enterprise value between 10 and 500 million in enterprise value. At my firm, you know, we tend to work on deals that are, you know, under 250 in revenue. So call it 2 to, you know, 25 in EBITDA, for example. So that being said, that's my world. That's my piece of this. The other stuff I'm kind of going to carve out and move to the side and say, hey, that's driving the headlines. And maybe that's what we're reading, but is that fair? Is that fair across all levels of deals right now? And I think what I'm going to suggest to you, you know, in an attempt to not bury the lead is that's not the case. You know, volume is down for a number of reasons right now. I think we're going to see it pick back up. I think we're at that inflection point at the bottom right now, if you will, in terms of actual number of deals. But I think what you're going to see is through the course of the presentation here is that valuations have held pretty strong. The market conditions are obviously very different, but it hasn't necessarily translated through into valuations. Valuations are very strong for good quality deals. So, at the end of the day, data is not as good at this segment of the market. So it's usually in your best interest to talk to somebody, like somebody at our shop or another investment banking group who's on the forefront of these deals, working the market day in and day out, because we're really going to have the best pulse for what's happening out there, as everything's happening in real time. Deals are not reported on a public basis. Some of the databases have limited data. So we get our hands on what we can get our hands on, which I will show you here in a little bit. But also you'll hear a lot of colored commentary from me as we go through it, and just kind of how I'm thinking about the data that we're seeing, what I think it means, and where I think we're heading through the rest of this year. So if you look at total U.S. private equity investment by year and the number of deals and the volume of deals, this includes those bulge bracket deals that I mentioned at the beginning. So obviously the numbers are higher than if you just carve out the segment of the market that we deal with here. But you very clearly see what was a huge run in 2021 and 2022 when there was, economic stimulus injected into the market that was really, driving deals, along with the fact that, rates were so low, money was virtually free, and folks were out there putting it to work in the M&A markets. But I think if you look back at the headlines that I mentioned a short while ago, it's very easy to make the comment, we're down off of last year. We're down off of 21 and 22. No kidding. I mean, look at 21 and 22. They were wonderful years, for M&A. So what does that really mean? Does being down mean the market is down? No, that's just a headline. So I think you want to keep an eye on that and understand how far out there, or how far in excess 21 and 22 were, and consider that when you're kind of considering the headlines that you're reading. So if we look specifically, it's a little easier when you're looking at the data to get your hands on some of the private equity data that's out there versus some of the strategic data. So I carved out for you some of the data that's available on platform acquisitions by quarter and by year for the last couple of years. And as you saw on the graph with total transactions, you see a pretty big uptick in 2021. As everybody, I think, already knows, the fourth quarter of 21 was just a gold rush in terms of M&A and getting deals closed. I think when you look at the first quarter of any year, the following a fourth quarter like that, the question always is how much spillover of things that didn't get done in the fourth quarter. So I think 22 Q1 is kind of reflective of Q1 of 22 is reflective of Q4 of 21. And then, the rate hike started happening in Q2 of 2022. So you kind of had this runaway inflationary environment. And in Q2, the Fed started to address that. And you see the result of those hikes on the number of deals, number of platform deals as that were getting done. So if we're looking at Q1 and Q2 of 23, which is all the data that's available at this point, Q3 is obviously still very raw. We're still down a bit, but I'll explain a little bit why I think that is. And keep in mind, the graph that you're looking at now is private equity platform acquisitions. And if we take a look at add-on acquisitions, so again, private equity driven quarterly data, it's not so drastic of a decrease. I think add-ons, are still happening at a very good rate. You're not going to see the same level of decline. And, I think why that is, the market has kind of split itself in many ways, and that there is a real drive for quality right now. And we'll talk about that when we get to the valuations a little bit. But when you're looking at the quarterly data specifically, remember that M&A always has and always will be very seasonal and very cyclical. I talked a little bit about the first quarter and how that's usually reflective of deal activity of Q4 of the prior year. Things tend to slow down in the summer. Don't know exactly why that is, but I'm gonna guess that folks are on vacation, kids are off of school. Folks are just kind of focused on some other things that are detracting a little bit, maybe from business, and just the deals tend to go down in the summer. Things always pick back up in the fall, which is why I think when you see the Q3 data that's going to start to fall in and layer in over top of this, you're going to see an uptick there. And I think you're kind of going to see the bottom, if you will, of that U shape or that V shape. And then obviously in Q4, the stuff that folks have been working on all year, everybody's trying to put that down and get that done before the calendar flips over. So you usually see your highest levels of activity in Q4. So I kind of go back to those headlines that we started with being a little bit misleading right now in the fact that volume is down. Pretty typical, I think, as the calendar turns. But I do think you're going to see a run up here, Q3 and Q4, which isn't yet reflected, in that data. So let's take a quick look at valuations. This is from GF Data, which is a private equity reporting group. And so if you look at the total enterprise value, or essentially the debt and equity, the transaction value, that's on your left. So we have different categories, 10 to 25 being the smallest that's reported here, and 250 to 500 million being the largest that's reported here. So if you move across those rows and you say historically, where do we stand relative to historical valuations in terms of multiples, I think you see, especially in that 10 to 25 range, you see a bit of a dip off of 21 and 22. But you see, some consistency there in the 25 to 50 million enterprise value. You see another little dip between 50 and 100, and an actual uptick in the larger deals. Again, I think there's fewer of those happening, but the valuations are very steady and very strong. So one thing that I want to point out to you on this particular graph, and something that I think we'll come back to towards the end here, is I talked to you about 21 and really how that was a gangbusters year, 21, 22, and how valuations kind of ran up there. If you look back historically, 2003 to 2018, look at how those multiples compare to year-to-date 2023. Now, you don't see that same drop-off. So if we go back to a volume-driven market, we go back to free money and economic stimulus really driving up those 2 years that I showed you above and beyond historical levels, it really does speak to the fact that the multiples were also going up with the volume of deals, and it was really more of an outlier than the norm in which we should be judging the current state of the market off of. I will suggest to you here today that a better metric is a longer term horizon. Look back a little further, exclude those couple years where things were at all-time highs, literally, and look back a little further, and you'll see that the market is actually very good. Valuations are very good. Everything that we're seeing here in terms of volume, in terms of valuations and multiples that are being paid for deals are very good and very strong and in line with what we would expect to come in. We're not seeing discounted deals. We're not seeing buyers taking advantage of sellers by no stretch. Buyers are in need of good quality deals. Good quality deals are selling at high multiples, fair multiples, and in many instances, premium multiples. So again, I don't want the data to be skewed when you're looking at 2021, for example. I also want to point you down to the bottom of this graph. The N is the number of transactions. And this goes back, and it's a different data source than the last charts we looked at. But again, you're talking about potentially, if that's Q1, Q2 data that we're looking at, it's half a year. Let's call it 270 transactions anticipated in 23. if we were to stay consistent at the rate that we're at right now. But as I already mentioned, I think the rate's going to increase. I think volume's going to increase. So I do suspect we'll end something a little closer to, what has been historical there at, a little over 300 a year in terms of number of transactions in the private equity space for lower middle market. If we slice this data a little bit differently, look at it by industry, I think what you'll see here is a lot of the same and much of what you would expect. The asset intensive companies, the companies that are, primarily driven, deals that are driven off of asset-based lending, where the cost of debt has gone up substantially. The multiples have come down a bit there, relative to the last 2 years. But again, I point you back to the 03 to 18, the 2019 data, and you'll see again that we're very much in line on the manufacturing side. Maybe the premium has gone away, but the multiples are still very good. They're very strong, and several of the other industry sectors are above historical levels at this point in time. So by no stretch are valuations down or sellers being punished. It's quite the contrary. We break this down by quarter, same data, looking at it a little bit different. You do see that Q2 summertime volume go down, from 78 to 57 off of the first quarter. You do see, the cost of debt. You do see the cost of money starting to come into play here as these deals get closed. Capital being more expensive, valuations did take a hit in Q2. As folks really wonder where this is going to settle out at. Obviously, the Fed met yesterday. They did not increase rates. So I do think there's some comfort that we're starting to gain here with understanding what the cost of debt is at this point in the game. And I do think, again, you'll start to see this come back up in Q3 and Q4 as the debt markets stabilize. So as I mentioned previously, we're really talking about a flight to quality that's happening here. Good quality deals are selling at good valuations and good prices. Lower quality deals, I think, they are what they are, and they're in need of some exit planning before they can really get, those premium multiples. But at the end of the day, valuations are very much in line with historical. And, the headlines are really being driven off of 21 and 22, which candidly is a bit misleading. Let's take a look at the cost of funds that I just mentioned a short while ago. This is a nice chart that the blue represents the amount of senior debt in a deal right now. And as you can see, for 23, that has decreased. I don't have the data yet for Q2 on this to drop in, but you went down from 41% to 38% in Q1 in the amount of senior debt. Sub debt decreased slightly as well, which obviously is causing buyers and acquirers to inject a little bit more equity into a transaction in order to get it across the goal line. So if you think back to the valuations that we just talked about, the multiples that have decreased a bit, I think this is a large driver in why you're seeing that. As the cost of funds goes up, the amount of equity goes up that's in a transaction, the purchase price that you're able to pay for that same earnings goes down a bit in order to make all the math work. And so the other piece of this, which I want to mention, is that this is private equity data, right? This is data that's compiled from private equity transactions, meaning, I don't want to say it's a math equation, but in many respects it is, right? The numbers have to work, the returns have to make sense, in order to justify the deal. The fact that these databases do not do a good job of capturing strategic transactions, and I'll define a strategic transaction as, a company in an existing industry acquiring either a competitor or a supplier or a customer, and horizontally or vertically integrating. Maybe they're expanding geographically, expanding product line, expanding distributions. All the number of reasons strategic deals happen. Strategics tend to pay more because they have synergies that they can realize across the two companies. Maybe they take out some overhead. They're able to leverage customer lists from one product to the other and really expand the EBITDA or grow the EBITDA exponentially. Things that financial acquirers or individual acquirers can't necessarily accomplish. So when they're able to kind of drive a higher outsized return, they can afford to pay more as a multiple of EBITDA, and that's not in these numbers. So when you see the decrease in the numbers and you see the data that we're looking at, I think it's very, very important to kind of keep that in mind and understand that that's the focus of the data. And should you put these strategic transactions in here, not only would you see the number of transactions go up, but I think you'd see the multiples go up. I'm confident you'd see the multiples go up because that's a large driver, to some of this. And so, I think at the end of the day, those folks are able to extract a little bit more EBITDA out of these deals and make the math equation work, even if they have to put in more equity right now because debt is a little bit more expensive. Whereas if you don't have those synergies, where are you going to get your returns from to justify the additional cost of debt? It's a little harder to come by, so you take it out of the purchase price, which is the drop in the multiples that you see. So just try to kind of put a bow on that and pull that all together for you. In terms of lending multiples right now, the gray is senior debt. Year to date, we're seeing as you would expect, a slight decrease in the level of debt that we're able to put on these deals, and again, similar in terms of sub debt. At the end of the day, the deals are getting done. The market sets up very differently than 18 and 19. We looked back there in terms of, the valuation multiples that we were seeing as a good indicator. But I think you'd be remiss not to consider the fact that the market is very different now than it was in 18 and 19, right? The inflation, the cost of money is very different. So even though the valuations are similar, I think the market itself, is at a point where it's beginning to stabilize, and I think we'll see that carry through into Q4. So one of the reasons I'm so bullish on Q4 is our current backlog here internally. Every company that we're talking to, we're not necessarily taking on and representing for sale. So we are passing on opportunities, which is a fairly normal thing here. But when the market gets thin, the volume of calls gets lower, the number of passes gets lower, the amount of things in our inventory gets lower, and we're just not seeing that right now. We're seeing sellers come to the table. I think there's a bit of a lag in those getting to market for various reasons. I really think you're going to see a lot more companies that have hit the market in Q3 that will hit the market in Q4. And again, you'll see that adjustment then in the volume, the deal volume numbers, when we're looking back in 24 at what happened in Q3 and Q4 of this year. So I think the market is starting to settle in terms of what the rates are. Folks are getting comfortable with those. And I think, like I said, we're going to see a nice uptick here. Things that are not necessarily in the headlines that I want to make sure that we're thinking about that really support the narrative that I'm sharing with you is, at the end of the day, and all the time that I've been in this business, I've really learned that the rules of supply and demand, the laws of supply and demand are what drives the M&A market. And there's still a lot of demand out there on the buy side. I mean, private equity is still sitting on record levels of cash that was raised. They have to put those dollars to work. I mean, they only have a certain time period to make and invest those dollars. And if they don't invest those dollars, they're going to have a lot of difficulty, raising that money again in the future. So in my opinion, folks are going to, that's going to continue to drive the supply side. And the question becomes, will the demand, or seriously, that will drive the demand side. And the question becomes, how much supply will follow? And right now we're seeing it. So I feel very good about that. And then I guess the last thing to think about here, as I was combing through this data and really thinking about, what am I seeing? What am I looking at? Is, listen, private equity money is smart money. I mean, these are professional acquirers that do this for a living, and they become very refined in their processes and very good at what they do. And they're seeing the same data. And in my opinion, I think they've delayed some exits. A lot of folks that I've talked to have longer hold times right now than maybe the hold times that they've had historically. And so if you think back to the volume data that I showed you at the very beginning, and you see that decrease in volume, well, private equity is holding on for 7 years instead of 5 years before they roll out of an investment. I mean, that data that's reflected in the data, right? And that's affecting the end number that we were talking about before. So again, nobody likes an unstable environment. Nobody likes to not understand all the pieces and parts of this. And I think as you continue to see, the cost of debt stabilize, I think you're going to see the activity increase even more than it is right now. So at the end of the day, don't be fooled by the headlines. Lower middle market valuations have held up extremely well through this rate environment. Again, expecting a robust Q4, strong 24, and an overall return to normal or historical levels. Just to kind of wrap us up here, I thought I had a couple of slides here with some data of headlines of 18 and 19. But I did go back and I did look at the headlines of 18 and 19, and I said, okay, well, if we're gonna parallel 23 and 24 with 18 and 19, what was the market sentiment in 18 and 19? What were the headlines about M&A? And as you can see from the first couple of charts that we looked at, we were on that up and to the right trajectory. Everybody was very bullish. Everybody was very positive. And so I submit to you that, that's essentially where we're at today, is something similar to 18 and 19 pre-COVID. And I think that's the trend that we're going to see, this year and next year. So happy to take any questions that we might have here. John or Josh, I'm not sure who's with us at this point, but if you guys wouldn't mind moderating, or if we have any questions to come in, happy to answer those.
Yeah, sure. Thanks, Scott. Thanks again for the presentation. If you have questions, feel free to type those in now. First question here from Andy says, with the cost of money higher, what is causing the multiples to hold up? Is it the assumption that businesses will preserve their pricing power post-transaction?
That's a good question. I mean, I think it's, candidly, it's supply and demand. I mean, I think it's the amount of money that's been raised. We've got to find a place to put these dollars to work. And when I think about what I do for a living, right, as the market creator, we're always trying to drive competition in a deal to hold the multiples up. I hate to say it this way because I'm sure it's an oversimplification, but if you're not willing to pay, you're going to lose the process, because somebody's willing to pay to put their dollars to work. I mean, there's a velocity issue here too, as well as a return issue. So sometimes you have to compromise on the return side in order to, win on the velocity side, whether you want to or not.
Okay, thanks. And then someone asked, are you, I guess, because they're your slides, are you able to share slides or willing to share any of the slides from today with participants? A recording will be available, so you'll have access to the material that way. It'll be in the member center. If you want to copy that, reach out to us. But
yeah, happy to share any slides. I mean, you guys tell me what's the best and easiest way to do that, and then certainly be happy to make that happen.
Okay, yeah, Pete will make sure that happens. Can you speak about deal structure, past performance versus role of earnouts?
Yeah, I think that's a very good question as well. Those that are familiar with the earnout structure, I mean, it's one of the easiest ways to close a gap, a value gap, if you will, between what the seller's perceived value is and what the acquirer's perceived value is, you know, you earn them out when certain metrics happen. And if you were on this call, you know, 6 months ago, you would have probably heard me say that, you know, I expected an increase in earnouts out there. And that was how I anticipated that a lot of these, you know, the changing economic conditions would be solved in terms of structure. And we've seen a lot less of that than I would have anticipated. I mean, it's still out there, it's still happening, but to a lot lesser extent than I would have thought. So structures, I think what we have seen is probably, you know, the increased usage of reps and warranties insurance, you know, other factors to de-risk the equation a little bit, and, you know, the amount of insurance that's required, the levels that are being used. You're definitely trying to find a way to take some risk out of the equation, but it's not always in and around price.
Have you come across any deals where the buyer wants to structure it as a lease to own? And if so, how long of term and what imputed interest rate?
Yeah, but I have not seen that, a lease to own. And, you know, I don't know if that's happening out there or not. It's not something that has come across my desk at this point.
Okay. How are buyers, or how do you see buyers treating companies that had rough EBITDA numbers in, you know, 2020, 2021 due to COVID? You know, taking a hit down in EBITDA, but not recovering. Will they consider the, you know, pre-COVID EBITDAs, the 18, 19 numbers, and then forecast for 23, 24? Or...
Yeah, that's a good question. You know, my advice to folks has been, you know, to run it for a little while, let it stabilize, show people, you know, that what you believe is going to happen, what stabilization looks like, it really is stabilized. And I think a lot of the companies that we've seen come to market, you know, in the last, we'll call it 6, 9, maybe even 12 months, you know, they've recovered it, you know, from COVID. They already understand what their books look like. They've normalized already. I'm sure there's industries out there, and I know a couple that I can think of where, you know, there's still some inventory challenges. You know, all the inventory hasn't been worked off. Maybe they're dealing with customer deposits differently than they would in the past. But you know, I think for the most part, the data that's out there, and, you know, we usually have a 3-year look back period. You know, we're okay in terms of what 23. We're almost fully through 23, so we can project the last couple months with a fair amount of confidence. So you really say you have good 22 data, you have good 23 data. Understand that 21 might still be a little choppy, but that's 2 good years of data, and I think that's enough comfort right now to kind of get through it.
Okay. What time frame would you advise a business to run to show recovery, either in margin or sales growth?
I would say at least a year. I mean, 2's better, but I would definitely put a year down. If you don't have 12 months of good hard data, you're going to have to answer a lot of questions that are probably, and that's, again, that's the challenge at this segment of the market, is good quality data, right? In lower middle market businesses, you know, business owners don't track everything. They don't have access to data that can answer all the questions that professional buyers have. And so I think the more data that you can put down, if all the data that you have is your financial statements, you're going to have to run out a longer period. If you're tracking KPIs and you have more indicators that you can speak to and you can show, obviously you can cut down that time frame a little bit. But in my experience, a lot of the size businesses that we're dealing with don't necessarily have access to all of that. And so I would say it's got to be at least 12 months, if not more.
And then a question did come in about if there's going to be future quarterly updates from REAG on EPI's platform. So the answer is yes. We're going to do these sessions on a quarterly basis with Scott. So the next one we have scheduled is actually for December 21st, Thursday, December 21st at 1 p.m. You can sign up for that now. But they also did ask, and I think this would be helpful maybe, is there a way for participants to get on REAG's email list or mailing list to get these types of updates from you directly?
Yeah, absolutely. I mean, just, you know, shoot me a note. It's Mashuda, first initial, last name, at REAG.com. I think we also have info@reag.com. There's a number of different places you can reach out to us at. That's all on our website, which is obviously reag.com. So yeah, feel free to reach out, get in touch, hit me with a note on LinkedIn. We'll get you added to any and all of our distribution lists that you want to be on. We'll make sure that we continue to feed the content that you want. If there's anything that we didn't cover today that you want to know, you want to understand, or you want to see included in future updates, let me know that as well. I mean, obviously, I have the pen in terms of figuring out what information to exclude and exclude in these. So be happy to include anything that the audience thinks makes sense or would be a benefit.
Okay, cool. And every time I think we have the last question, I get another one typed in there. So a couple more quick ones. Does anyone at the firm handle buyers in the lower market segment healthcare under $10 million?
Under 10 million might be challenging for us, but I can certainly give you a couple of firms that specialize in that space, specifically healthcare. So whoever had that question, reach out to me. I can give you one or two shops that handle buy side engagements there, and sell side as well. And yeah, I even have some folks that are on the private equity side in that space too. So there's a number of resources we can connect you with, and they can maybe even direct you in who they've had the most luck with or success with as well.
Awesome. And are you seeing any trends in the types of sellers coming to the market? Any trends in the types of businesses they're bringing? And then for those sellers, such as the baby boomers, do they have high price expectations, or are they simply looking to secure their retirement?
That's a loaded question. There's a lot there to unpack. In terms of types of businesses that we're seeing, what am I seeing that's common across those sellers? I would say if there's one thing, it probably is age. It probably is a desire to get off the hamster wheel that folks have been on for all these years. I mean, it's hard to say, but everybody hits a retirement age, and I think through the inventory that we have right now, the folks that we're talking to, I think that is a fairly common theme. And what were the other parts of that question?
Yeah, so it's like the trends of the types of businesses, and then those sellers, they have high price expectations, or they're really looking to just secure their retirement.
Okay, yeah, no, good question. So and again, this is the trends that I see. So we see a lot of manufacturing, we see a lot of distribution, and we see a lot of B2B service, which is why I was scratching my head a little bit, some of the manufacturing multiples that showed up in Q2, because I haven't seen that decrease in the multiples on the manufacturing side. The only thing that it led me to, which I shared during the presentation, was the cost of debt. But the manufacturing and distribution stuff, I think it's where we sit in the world, not necessarily because that's reflective of any particular industry. I sit in Cleveland day to day. Todd's out closer to Philly, and Jacqueline's in Pittsburgh. So just being in that mid-Atlantic, Great Lakes, there's a lot of those companies around. I mean, we do business nationally, but we tend to be in and around those industrial manufacturing distribution type businesses. Don't see a lot of tech, don't see a lot of healthcare at our shop. So, but that has remained fairly consistent. I don't necessarily think that's any driver or indicator of the market as much as it is, kind of who we are and how we're built. So I don't know that I have any great insight into, a seller's mindset, what they're thinking right now. Is there any commonalities that are running through these? Not necessarily. I mean, I just think that the market remains strong. We're advising our clients and folks that we're talking to accordingly to not follow the headlines, to not be afraid to go to market because you think valuations are down. We're fully confident in our ability to build a robust market and to help them maximize value. And candidly, right now, we're putting our money where our mouth is. I mean, our deals are strong. The IOIs that we have in, the LOIs that we have in on the deals that we're marketing are all very, very good and very much in line with what we hoped for when we went out to market. So I don't know that I have a whole lot more than that.
Okay. Well, appreciate that, Scott. And I think that does it for the questions we have. But again, if you have questions that you think of after the fact or didn't get covered today, reach out to Scott and his team directly. They're more than accommodating, happy to answer those. So thank you all for participating. Scott, thank you especially for your time. Again, join us in December where Scott will be back presenting again. And then for those of you who are signed up for CEPA, upcoming CEPA course, you'll see Scott in class and in the faculty meetups as well. So it's always a treat to have Scott and Bobby on those faculty meetups. So thanks, Scott. Thanks, everyone. Enjoy the rest of your day. We'll be in touch and talk to you all soon.